Dan McDermott from the Chart Guys joins us again this week. Hey, Dan, how are you?
Good, James. How you doing?
I am feeling fine, thank you. Quite the uproar in the market with the departure of Terry Booth from Aurora. A little bit of life in that stock. What's the sector telling you today?
Well, the sector is certainly in despair mode. We've seen weakness the past couple days, and now it's just really boiling over. And we're looking at ACB with little support in this range, down at 150, which is the lowest price we've seen in this whole pullback. That's pretty much all we're looking at. We then had a short report released on CGC. They're down 6% at the moment. No short-term catalysts on the horizon. We're pretty much just looking to the election, which is still 11 months away, 10 months, 10 and a half months. So bottom line is we are in a despair point of the market cycle.
Okay, well then let's talk about something that's more fun. How about Tesla?
Tesla has been a day trader's dream. So I've been saying to people that watch my videos, 2017, 18, and 19, CGC, hands down, my most profitable ticker by probably 1,000% plus from the second most profitable ticker. That has been my horse. In 2020, I am red trading CGC, and Tesla has now been, it's the complete opposite. Tesla has all of my profits in 2020. So I, like many traders, are moving on from less opportunity in this sector, more opportunity elsewhere. You better believe I'll be back when things change. But as of right now, the opportunity is elsewhere.
Sure. And in terms of the FANG stocks, they seem to be, doing what they're usually doing, which is more or less incrementally rising over time. Is there any reason to think that's going to change?
No, my outlook on the market is as long as we're in a weekly uptrend in the S&P 500, all dips are for buying. And it's been working time and time and time again, maybe 4 times in a row over the last 6 months. And eventually it won't work, absolutely. But until that happens, doesn't matter what the headline is to me. I'm looking to buy the dip if we are in a weekly uptrend. When we lose that weekly uptrend, I will be singing a different tune. But that is not the case.
Sure. And so the S&P generally still FANG driven for the most part?
FANG, tech sector has the most exposure. We've got Apple and Microsoft very high on the list, but all those names, Facebook, Netflix, Amazon, even the names that had a bearish reaction to their most recent round of earnings like Facebook have completely recovered and bounced to higher highs. So overall, we got Amazon at all-time highs today. Market hit all-time highs yesterday. Apple's just under its all-time highs. So very quickly, the market has disregarded those virus fears for now. And the question is, how long can the Fed keep pumping money in and keep this going? I don't have an answer. So again, keep playing what's working until it stops working.
Yeah, I guess that's the bottom line, isn't it? So touching briefly on the coronavirus, I mean, it certainly caused some market gyration, but not nearly as much as I would have expected. Do you think that the recovery that has clearly instilled itself in the market is a result of the headline catalysts like Gilead is coming out with a virus, all these other companies have said they've got treatments coming down the pike, and then of course Donald Trump said that the virus has been shut down 5 days before declaring it a public emergency, so I guess that's all good.
It's definitely a factor. For me, I usually use price levels to determine anything, and I've actually held off watching. Netflix had a special, or one of their new shows or documentaries called Pandemic. I've intentionally not watched that because I didn't want it to influence my technical analysis. But the headline for me that was the turning point was China is going to inject $174 billion into the market when it opens after their long holiday. And that's just the market saying, okay, we've got central bankers and those in power continuing to prop things up. We're fine for now. And that kind of sentiment transitioned into the U.S. market buying the dip.
Right. I was looking at a chart of the entire derivative sector, and it's now estimated to be total notional value of as high as $1.2 quadrillion. Which is the first time I've heard that measure used. But to me, that sort of indicates that, well, if we're going to measure the derivatives market in quadrillions, then there's no reason to stop printing money if all of the economic perceived benefit comes from printed money. Then how soon till we're measuring stimulus in trillions and quadrillions and quintillions?
Yeah, it's over my head from a macroeconomic standpoint. That's obviously not my specialty. But it's the kind of thing where, the conversation that someone posted recently where they have with people, where people say, I'm not bullish in this market, it's manipulated. Well, the question is, which direction is it manipulated? The answer is up. So why are we fighting these market bulls? If it's manipulated to the upside, yes, it can be a house of cards. That's what stop losses are for. Being protective is absolutely always important, but don't fight these bulls.
Right. Dan, can I ask, what is your preferred trading platform?
I use Fidelity, and I've always used Fidelity. I'm on 9-10 years at this point. I just haven't had a reason to switch. When we had the US go fee-free recently, they were one of the last companies, and I remember messaging them being like, all right, I'm going to give them 1 week, and they finally did go to 0 fees. I like their customer service. I have no affiliation with them, but I haven't ever had enough of a reason to leave Fidelity.
And can you trade aftermarket and pre-market with Fidelity?
Yeah, it's 7 a.m. to 8 p.m.
Oh, perfect. All right, Dan, well, let's take a look at some of the charts here now.
So we'll start it off with ACB, and a big bummer for the sector bulls, as ACB over the last week, pretty much from end of January to start February, was the strongest of the major names just because it was able to see this little daily higher low and higher high. Obviously, that faded very quickly with the big gap down, and here we are near the low of the reaction during regular trading, 165, and after 165, it's just 163 and 150 as the only short-term support levels nearby before we are back in free fall mode. So 150 now becomes the most important support level. It wasn't just the fact that we had Terry Booth leaving, but we also had, they gave some insight into what they're expecting for their earnings, something like 60 to 64 million, maybe a little bit more than that, 62 to 66, something along those lines. But just no good news in the sector is what it boils down to. Very little to get retail traders excited about. And for CGC, it was perfect timing to release their short report. I have no doubt, call me a conspiracy theorist, but I would speculate that if 2134, which is the only support level nearby, if 2134 had held yesterday and we closed at the high of the day, I don't think we see that short report today. I think we see that short report today because 2134 broke. The next support below that level is 2014, a 6% drop. We have the bearish cloud over the sector from ACB this morning. It was just the stars aligning. And it's the kind of thing where if I just put myself in their shoes, if I'm the kind of trader that has reports that people are going to react to, I'm going to wait to put those out until the setup is ideal. And yesterday into today was the ideal setup for the key support break, the lack of any support directly below it, and the bearish piggybacking off of ACB. So I personally don't care what the report says whatsoever. All I care about is what the price is doing in reaction to it. We're still watching a weekly uptrend. Obviously, at this point, we pulled back from the high very significantly, 15%. More than that, we're looking at more like 30% from that high. And we're still in a weekly uptrend. 1848 is the must-hold support. That's still 5% away. So we could still maintain the weekly uptrend if it's a bullish reaction to earnings. So those earnings that are approaching, we have an ETF rebalancing at the end of next week. Those are two events that need to be bullish to save this weekly uptrend. If it is a bearish reaction to earnings on CGC, the monthly bear flag possibility is going to increase a good bit, and we're going to be looking back at 1381 if it is a bearish reaction to earnings. So that's what we're looking towards in the short term right now. What is Canopy's reaction to earnings going to be? And here's the S&P 500 to check in. Weekly time frame. We're scared about the virus. What virus? Very short-term memory of anything fear related. Look at that recovery. 1, 2, 3 gap up opens in a row. All-time highs, 2 out of the last 3 days. Market bulls continue to keep complete control. And all that does is just twist the knife a little bit harder into the MJ sector bulls who see all these other sectors performing really well continuously and seeing no benefit from that. So patiently waiting for opportunity, volume, volatility, and hype to reemerge in this sector, but might have to wait until fall of this year for the election cycle to do it.
Hey, Dan, thanks very much for joining us today. We'll see you again next week.
See you next time, James.